If you've ever tried to get your money together, you've felt this. You log on and are immediately hammered by 50 different voices telling you to buy crypto, slash your budget, and download half a dozen apps just to track your morning coffee. It's overwhelming. This is the objective reality of financial independence. Active, portfolio, and passive income combined completely fill your living expenses bucket. You get there by building a cohesive ecosystem, a structure where your savings, investments, and income generation work in sync. Ultimately, this is about buying back the freedom to make your own choices. But building that system requires matching your tools to the actual reality of your lifestyle. Every financial tool you use exists on a single spectrum, the trade-off between active control and automated convenience. This chart maps that trade-off. High-effort tools give you total precision and control. Low-effort tools save you time, but they limit your ability to deeply optimize how your money moves. Most people abandon their financial goals because they misalign these demands. They pick a tool that requires 10 hours a week when they only have 10 minutes. To find where you fit on this grid, we need to evaluate your choices across 3 pillars: your cash flow, your investing, and your income. Pillar 1 is cash flow. For a lot of people, the appeal of modern apps like Simplify or Rocket Money is the promise of automation. You spend 5 minutes connecting your bank accounts, and you get instant visibility of your net worth and automated savings targets. However, passive observation rarely changes behavior. Seeing a chart of your spending doesn't necessarily force you to rethink your habits the next time you're at a checkout counter. This matrix compares that automated approach against the strict zero-based budgeting strategy used by tools like YNAB. YNAB requires you to assign every single dollar a specific job the moment you earn it. It is a proactive system with a notoriously steep learning curve. It demands high weekly maintenance. If you are already stretched for time, that level of manual input creates a lot of friction. Your choice here depends on your willingness to actively confront your spending behaviors, rather than just observing them from a distance. Pillar 2 is wealth multiplication. To remove emotional decision-making, many investors shift toward algorithm-managed robo-advisors. If you're a beginner, the entry point is low. Fidelity Go is a primary example of this low-friction model. Look at the entry requirements. With Fidelity Go, a $10 deposit grants you a managed portfolio with 0 advisory fees, provided your balance stays below $25,000. The trade-off is that these entry-level tools rely on very basic market strategies. They lack the advanced optimization features that can save you more money over time. Now, look at the Schwab column. This is built for high capital savers. Features like automated tax loss harvesting, which can offset your capital gains, only become available once you cross that $50,000 threshold. That is a high barrier to entry. Additionally, Schwab's structure requires you to keep a portion of your portfolio as uninvested cash, which means that money isn't working for you in the market. Algorithmic investing is only truly hands-off if you have enough upfront capital to enable those advanced features. Finally, Pillar 3, active income. We need to be direct. The idea of frictionless, instant passive income is a myth. Building a niche blog is a good example of how this actually works. It functions as a scalable media asset, not a hobby. This timeline shows the reality of the input required. You produce 2 to 4 optimized articles every single week, and for the first 12 months, you earn absolutely nothing. If you survive that first year, the revenue line can hockey stick upward. By months 14 to 24, affiliate marketing and ads can consistently generate over $1,000 a month. The trade-off is a massive time sacrifice and a high vulnerability to algorithm changes that can wipe out your traffic overnight. What people call passive income is actually heavily deferred active labor. Of the 3 pillars, this one requires the most time bandwidth. Reaching independence is about combining these 3 pillars into a tech stack that matches your current capacity. Profile 1 is the overwhelmed beginner. With low time and capital, you need automated systems. Apps negotiate bills and automate deposits, ensuring daily progress. Profile 2 is the set-and-forget saver. You have high capital but little time. Front-loading capital into a platform like Schwab provides access to algorithmic tax optimization. You trade cash requirements for a system that manages itself. Profile 3 is the active optimizer. You have the time bandwidth, and you want maximum control. You treat personal finance like a second job. You maintain a strict daily budget in YNAB and grind out weekly content to build a new income stream. You gain maximum leverage and diverse income sources, but it comes at the cost of a significant lifestyle sacrifice and high cognitive load. You have to honestly assess which of these profiles matches your daily reality right now. Financial independence is about sustainability. Success comes when you match a tool's required input to your daily reality, and keep it there.